Hey guys, welcome back to the channel. Now, something very interesting's just happened in the financial markets. US government bond yields were surging. Then, the US Treasury stepped in and announced that it was doubling the size of some of its planned long-term buybacks. And almost immediately, the charts moved. Bond prices jumped, long-term yields dropped, the dollar weakened, risk assets rallied, and Bitcoin suddenly exploded higher, eventually pushing back above $70,000. And then something even more interesting happened. The bond market started reversing. Yields began climbing again despite the intervention. And now US Treasury Secretary Scott Bessent said that those bond buybacks could potentially become even larger. So what exactly is happening in the world's most important bond market? Why is the US government buying its own debt back? Why did Bitcoin react so aggressively? And what could Japan, America's largest foreign holder of US Treasuries, possibly have to do with the bigger picture? Because once we connect what's happening in markets this week with something the US and Japan did earlier this month, there's a much bigger story developing. And to understand it, we need to start with one slightly confusing thing about bonds. Why do bond prices and yields move in opposite directions? If you've looked at financial markets recently, you've probably heard people talking about Treasury yields surging. But what does that actually mean? Let's keep it really simple. Imagine the US government issues a $1,000 bond that pays you $40 every year. If you paid $1,000 for that, that's effectively a 4% return. But imagine investors suddenly became less willing to own that bond. People start selling. Its market price falls from $1,000 to $900. That bond is still paying the same $40, but someone buying it for $900 is now receiving a higher return relative to the price they've paid. That's why bond prices and yield prices move in opposite directions. Bond prices fall, yields rise. Bond prices rise, yields fall. Remember that because it explains most of everything that happened next. Long-term US government bonds had been under serious pressure. Investors are currently trying to price several risks at the same time. There's still concerns around inflation. Energy prices have been elevated. The US continues to run very large budget deficits. And total US government debt has now moved beyond $40 trillion. That matters when you're asking somebody to lend the US government money for 20 or 30 years. If investors think inflation could remain higher, or if they're worried about the enormous amount of government borrowing the market may need to absorb, they can demand a higher return for holding that debt. So existing bonds get sold, prices fall, and yields rise. The US 30-year Treasury yield climbed to levels we haven't seen since before the global financial crisis. And then Washington did something that immediately caught the market's attention. The US Treasury announced that it would double the maximum size of some of its planned buybacks of longer-dated government bonds. In simple terms, the Treasury is going into the secondary market and buying back some US government debt that's already been issued. And there's an important distinction here. This is not quantitative easing. During QA, the Federal Reserve creates central bank reserves and buys securities as part of monetary policy, deliberately trying to influence broader financial conditions. This is the Treasury managing the government's debt. The stated purpose of these buybacks is to improve liquidity and the functioning parts of the Treasury market, but markets still reacted. Suddenly, there was additional demand for those longer-term bonds. Bond prices moved higher, and because we've already learned that prices and yields move in opposite directions, long-term yields dropped. And that is when things became particularly interesting for crypto. As yields fell, the dollar weakened and the financial conditions became a little more supportive for risk assets. Bitcoin surged, Ethereum surged, crypto-related stocks moved higher. But I want to be careful here. I'm not saying Treasury announced a bond buyback and therefore Bitcoin automatically went up. Markets don't work that neatly. There were other catalysts in play, but the change in the bond market was an important part of the wider macro environment in which that crypto rally happened. And once crypto started moving, another mechanism kicked in: short liquidations. A lot of traders had positioned themselves for crypto prices to fall. Instead, Bitcoin started moving rapidly higher. Those bearish positions began getting liquidated. Around $2.7 billion worth of crypto shorts were reportedly wiped out over the following 24 hours. That can create a feedback loop. Prices rise, shorts get liquidated, those positions are forcibly closed. That adds further buying pressure. Prices rise again, and Bitcoin eventually pushed back above the $70,000. So while everyone was staring at the Bitcoin chart asking what just happened, part of the answer was sitting in an entirely different market, the US Treasury market. But then came the part that I find even more interesting. The relief didn't last. If those Treasury buybacks had completely solved the underlying problem, you might have expected long-term yields to have stayed down. They didn't. The following day, yields started climbing again. A significant part of that initial move reversed, and that's important. It suggests investors aren't simply worried about short-term liquidity in the Treasury market. They're looking at much bigger questions: inflation, government borrowing, fixed Treasury issuance, America's budget deficit, and ultimately, what return do investors need to be paid to lend the US government money for decades? Treasury buybacks may improve liquidity and market functioning, but they don't make those underlying fiscal questions disappear. And now Scott Bessent has said the expanded buybacks could potentially be increased further if necessary. Which brings us to another part of this story, because America has already been thinking about how to prevent one enormous Treasury holder from becoming a forced seller, and that holder is Japan. Earlier this month, the Japanese yen had fallen towards levels not seen in around 4 decades. Japan intervened to support its currency, and unusually, the United States joined that intervention. But Japan has an interesting problem whenever it needs large quantities of US dollars. Japan owns an enormous amount of US government debt, around $1.1 trillion worth of US Treasuries. That makes Japan America's largest foreign holder. So imagine Japan needs a huge pile of dollars to intervene in its currency. One way of getting those dollars would be to sell some of its US Treasury holdings. But now think about what we've just learned. What happens if a major holder starts selling treasuries? More supply hits the market, bond prices can fall, and when bond prices fall, yields rise. That's potentially extremely inconvenient when Washington is already dealing with pressure at the long end of the treasury market. And that's why something Scott Bessent said around Japan's intervention becomes really interesting. Bessent encouraged greater use of something called the Federal Reserve's FEMA repo facility. It sounds incredibly complicated. The basic idea isn't. Imagine Japan has this enormous pile of US Treasury bonds but needs dollars. One option is sell treasuries, receive dollars. But through FEMA, foreign official institutions can potentially do something different. They can temporarily use their treasury securities to obtain dollar liquidity from the Federal Reserve. So instead of having to dump those bonds into the market, they can effectively borrow dollars against them. That distinction becomes extremely important when the US Treasury market itself is already under pressure. And I want to put a very clear line around this part of the story. There's no evidence that Japan caused this week's expansion of Treasury buybacks. Bessent and Treasury have described these buybacks in terms of improving liquidity and market functioning. So I don't want to turn a genuinely interesting macro connection into a conspiracy theory, but we can look at what's happened over the last few weeks. The US helped Japan intervene in the yen. Bessent encouraged a mechanism that can reduce the need for foreign governments to sell treasuries to obtain dollars. Long-term US yields then surged. Treasury doubled the maximum size of some long-term buybacks. Yields initially dropped. Bitcoin and other risk assets rallied. Then Treasury yields started climbing again, and Bessent has said those buybacks could potentially become even larger. Those events do not prove that one caused another, but they do revolve around one increasingly important question: who is going to absorb America's government debt and at what price? And this is where we come back to crypto. Bitcoin doesn't exist in this completely separate financial universe anymore. It's increasingly trading inside the same global liquidity environment as everything else. If Treasury yields surge, investors can suddenly earn much more attractive returns from assets traditionally considered low risk. Financial conditions can tighten, the dollar can strengthen, and speculative assets can come under pressure. But if yields suddenly fall and the dollar weakens, some of those pressures can reverse. And Bitcoin can respond very quickly. But there's another possibility we need to think about. What if yields are rising because investors themselves are becoming increasingly worried about government borrowing, deficits, inflation, or long-term fiscal credibility? That's a different story, because in that environment, assets such as gold and potentially Bitcoin can start attracting attention for completely different reasons. Not because financial conditions are becoming easier, but because some investors are looking for assets outside traditional government money and debt, and that creates a fascinating tension. Bitcoin could potentially benefit when yields fall because financial conditions become more supportive. But it could also attract interest when concerns about government debt and currencies themselves start increasing. Those are two very different Bitcoin narratives. And right now, we're starting to see those narratives collide. So, what happens next? For me, one of the most important charts to watch over the next few weeks might not actually be Bitcoin. It's the long end of the US Treasury market. If yields settle back down, this week's intervention may ultimately have helped relieve some of the pressure in the market. But if long-term yields keep climbing and Treasury keeps increasing these buybacks, then the question becomes considerably bigger, because the US government still needs to borrow enormous amounts of money. Japan still owns more than $1 trillion of US government debt, and other governments, banks, pension funds, and investors own trillions more. And ultimately, someone has to be willing to hold it. So instead of only asking, why is Bitcoin pumping? I think there's another question we should be watching very closely. What is the bond market trying to tell us? Because what happened this week showed just how quickly a move in the world's biggest bond market can spill across the dollar, stocks, and eventually into crypto. And if this pressure in the Treasury market continues, Bitcoin might not be the most important chart on your screen. So this is definitely one I'm going to keep watching, because if long-term yields continue pushing higher and the Treasury responds with even larger buybacks, this story is far from finished. But I really want to know what you think about this one. Do you think this is simply Treasury trying to keep the bond market functioning smoothly? Or do you think America's growing debt burden is starting to become a much bigger problem? And where do you think Bitcoin fits into all of this? Let me know in the comments. I'm genuinely interested to see where everyone lands on this. If you found this useful, like the video, subscribe to the channel, and we'll keep following this as it develops. Thank you so much for watching, and I'll see you in the next one.